How much money do you need to start in the real estate market? I would start with at least $10,000. And the reason why I say that is if the average house, let's just say you start looking at properties that are in like the $100,000 range. With $10,000 doing a conventional loan or FHA loan, FHA is going to be 3.5%, conventional loan is going to be 5%. You're going to have enough money with $10,000 to put some money down, cover your closing costs if they're not covered in your sale, and maybe have a little bit of money for any incidentals. That's, I would say, the minimum. And a lot of the banks are asking for 3-month and 6-month reserves. You're going to need to have over a 650 credit score, 10 grand, and income to support the mortgage that you're looking to get yourself into. Also, with $10,000, you can invest alongside someone else. I do that in my Killing the American Dream program, where you can do an earn and learn. You invest into a property as a group. You get direct mentoring, and then you get some sort of payout if it all goes well with the property, which it tends to. You'll get a payout, and that's kind of like your starting point. If I were completely doing a deal by myself as the first time, talking about maybe a $200,000 sort of property, sort of project, I would say about $60,000 of cash would be needed. That's going to cover your initial deposits, some float money, that incidental money. I think $60,000. I guess an easier rule would be to have about 30% of the project cost in cash. If you don't use the FHA option, you don't use the conventional option, buying that primary, home, owner-occupied property where you can get low down payments like that, then you're going to need to have about 30%. With hard money, for instance, they're going to want you to be in from anywhere from 10% of the project cost to 20% of the project cost. On the 10% side, put down your 10%. If it's a $200,000 project, 10% is going to be 20 grand, and then you're still going to need money for the months that you're going to be covering interest and maybe even paying for some materials and construction costs, that sort of thing. Also, that 30% applies if you're buying an investment property, just straight up, not fixing it, not rehabbing it, not flipping it, but you're being a landlord. 30% will get you in the door. You're a first-time home buyer. That means that you'll qualify for the FHA program. You want to keep your life simple? FHA, buy a 4-family home, 3 to 4 family, depending on your city and how it's going to be taxed. Okay. If it's going to be taxed as a single family home and you don't move into the commercial range like you would in New York City, get a 4-family home, renovate your unit so it's nice and you feel comfortable and happy with what your unit is. Rent out the other 3. That's going to have 3 outside incomes, most likely completely paying for your mortgage and allowing you to cash flow and offsetting your risk, right? So if you want to split between being an investor and getting your first home, that's the route to go, because you're going to put 3.5% down. You're going to get a home that you own, that's yours, but you're going to immediately create income that's offsetting your personal expenses, probably cash flowing, is going to allow you to save up, gain experience, and get more money to do your next deal. Maybe the next one is your house, right, that you live in. You get another, primary residence. You could do that one as a conventional loan for 5% down. It's going to be your primary residence. It'll qualify. Change your property type. You no longer want a 4-family. And now you have your investment property, the 4-family, now 4 people renting, still cash flowing, still paying on the mortgage, and you have your own homes. Take advantage of the first-time home buyers' low down payment. Get a multifamily. The more units, the better. And that's how I would start if I were you. I would probably say my biggest fear was being wrong. I don't really like to be wrong. I like to be right a lot. I'm not really afraid of losing money. I've lost lots of money in stock transactions and some bad real estate deals, bad business opportunities. So money is not something that freaks me out. Credit getting damaged is not something that freaks me out either. I've been there and recovered. So that's not like a fear point. I just don't like to be wrong. I don't like to go out and say, yo, I'm going to do this thing, I'm going to be successful at it, and then have to come back and be like, yeah, that thing didn't work out. That's probably the worst experience for me is to be wrong, more so than being wrong and losing money. That's probably my biggest fear. Yes, you can. You would be able to use business credit if you wanted to. That's your prerogative. As long as the money is legal, I really don't care where you get it from. The thing that I care about the most is that you're not stressing yourself out to invest in the deal. I don't think anybody should invest more than they can tolerate. So if you're taking out business credit, make sure that you have the underlying cash to service that debt. So let's just say it was 20 grand and your payments $300 a month or whatever it would be, right? 400, something like that. And you're tying that money up for 6 months, maybe 9 months. Make sure you have the underlying cash so that you're not stressed out, and make sure that obviously the profit that's being turned on the investment is going to be more than your debt service so that the deal makes sense. But if you want to use business credit, you could go for it.